Hi, Maddie.
Hello.
Fast food operators, restaurant brands. So which ones, well, can we say bringing home the bacon for them?
We could say that. We could say bringing home the bacon. I quite like that. Now, a word of caution, this story may make anyone driving home from work this evening a little bit hungry, because it certainly makes me hungry. So Restaurant Brands owns KFC, Kentucky Fried Chicken, Pizza Hut, Carl's Jr. and Taco Bell, which isn't here yet, but they have announced that it is set to launch here at some stage. Now, its financial year net profit was up just 0.8%. Now, we call that a flat profit. Now, that profit was $35.7 million, and its revenue, so its sales, were up 8% to $825 million. Now, that's a lot of fried chicken or bacon. Now, its three key businesses performed pretty well. So that's KFC in New Zealand, KFC in Australia, and Taco Bell in Hawaii. But it was a bit of a different story for its other brands here. So Pizza Hut in New Zealand, its sales were down just 0.2%. But Carl's Jr. in New Zealand, those sales were down 8.8%. It also sold off its license to operate Starbucks over the period. Now, its underlying profit was down about 37.5% too, so hence why they probably sold it there. But all of this hasn't actually deferred international buyers, because as we know, the Mexican-based private equity firm Finaccess Capital has just bought 75% of Restaurant Brands for $1.2 billion.
So while you're saying it's flat, and obviously there's been some decreases in the pizza, so it is the fried chicken and Burger King which are, well, bolstering their returns then.
Not Burger King, they don't own Burger King.
No, sorry,
Carl's Jr.
Carl's Jr.
So
yeah.
burgers and fried chicken are pretty lucrative, so this says.
Yeah, exactly. Okay, let's move on to a little bit of research, which I find really interesting.
It is very interesting.
They've made a list of industries basically that they think are going to be, well, the best performers and the ones that they think are set to flop over the next year, is it, Maddie?
For next financial year. So this is the research firm called Ibis World, based in Australia, not related to the Ibis hotel chain as we discussed earlier. So they've created a table of those set to fly and those set to flop. Now, they base that analysis on the current industries which are doing well and doing poorly, and also based on the trends that are set to affect those industries. What they found at the top of the table, those set to fly, was beekeeping, interestingly. So they expect the revenue in beekeeping to grow 8.1% next financial year. Now, they base that conclusion off the fact that consumers are becoming more health conscious these days, and also because demand for Manuka honey is growing exponentially, particularly in China. Now, close behind that was vehicle parts retailers. Now, they based that off the fact that a lot of cars in New Zealand are imported and are second-hand. So it's a pretty steady business to be in the business of fixing those cars when they break down.
Keeping them on the roads. Yeah,
exactly. Also close behind that was video filming services. So more businesses these days are looking to market themselves through video, as we are tonight on Checkpoint. So that's also expected to grow.
An online product, I imagine.
Exactly, and with social media too, that certainly boosted it. And interestingly, personal welfare services, so things like debt counselling and budgeting services, are expected to grow, which is a little bit sad, really, because that speaks to the financial stress that New Zealanders are feeling at the moment. Now, on the negative side of this table, the bottom of the heap was electricity generators. And this is a bit of an iffy one, because they expect their revenue to fall by 10.5% next financial year. But we must note that power generators are coming off a really large peak. So last year, they saw unprecedented rises in the price of wholesale power. So they're going to fall, their revenue is going to normalise and come back down to earth and normalise. So they're falling from a very high point there. Also behind them was newspaper publishing. As we know that story very well, they expect the revenue in that business to fall by 9.5% next year. So not too good for Stuff and NZME, they mentioned in their commentary. Also advertising and furniture retailing not expected to do so well.
Why is that? Because that's interesting, because when you talk about consumer confidence, you've often said that people are still buying big ticket items like fridges, etc. I would consider furniture to be among those things.
It is. Furniture is absolutely considered in big ticket items. Things like couches and also whiteware are among that list. But when you look at the likes of Kmart and IKEA also announcing its launch in New Zealand to come soon, consumers are seemingly looking at lower price points. So one would look into the detail of this and think that those furniture retailers, more like your Freedoms and things that have that higher price point, they are probably the ones that are set to struggle as these lower price point retailers come into action.
Shop around for a bargain. Okay, what else has been happening on the markets?
The NZX Top 50 index rose tonight about 0.2%, so that's 62 points to close at 9,908. The New Zealand dollar is buying at 67.6 US cents, 94.6 to the Australian, and 51.6 British pence.
Still wafting around those same numbers,
We
aren't we?
are, we always are.
All right, thanks, Maddie. That's Madison Reedy with Business News.